Now I'll spend a few minutes trying to explain the concept of the comprehensive income. Earlier we have said that as a part of IFRS or the reporting frameworks, the company has to present a statement of comprehensive income. And we said that the statement of comprehensive income contains two parts. One is an income statement, which is the profit and loss statement, and the other is other comprehensive income, right? So the income statement, we have clearly we have seen that the structure of it starts right from the revenues and ends up with the net income. And as a part of the relationship also, we know whatever the net income that comes out in this particular year, I subtract whatever the company is paying dividend in this particular year. This is going as an addition. Whatever is the difference that is coming out, this is going as an addition to the cumulative retained earnings that were there at the beginning of the period. So what we are able to see here is whatever the change in the net income that is coming up, it is impacting the difference here, and this difference is going and impacting the retained earnings on the balance sheet, which means the balance sheet is getting impacted because of the change in the net income. Now, this portion that is getting updated to the balance sheet, this portion of the operations, the net income that is changing and which is getting updated to the retained earnings and thus contributing to the balance sheet. So it is affecting the once the retained earnings is getting affected, retained earnings is a part of shareholders equity, and even that is getting impacted, right? But there are various other things that go and impact the shareholders equity without passing through the income statement. They are not treated as a part of the income statement. Retained earnings is one portion which is treated in the income, which is coming from the income statement and which is updating the shareholders equity. But what is observed is there are various other things that are typically updating the shareholders equity bypassing the income statement. Now that is what all those all those things go as a part of other comprehensive income, which means, see, there are a set of things that update the shareholders equity in the balance sheet. Shareholders equity section of the balance sheet, there are a few set of entries that update it. So any income statement related entries, they update what is called as the retained earnings portion, and that retained earnings portion is updating the shareholders equity. But there are various other pieces, other comprehensive income areas which do not go through the retained earnings. So they are captured as a part of other comprehensive income, which is again a part of this statement of comprehensive income, which go and update the shareholders equity. So these things, we need to understand what are all those things that go as a part of the other comprehensive income, because that is resulting in an overall change in the shareholders equity situation. So the comprehensive income, which is actually a combination of these two, the statement of comprehensive income is a combination of these two. It talks about all changes that are coming into the shareholders equity except the transactions that happen directly with the shareholders, like new shares or buyback of the shares or the dividends. So except for those stuff, they are all directly impacting the shareholders' equity. So I'm looking at the comprehensive income, except for the contributions and distributions, all other things that are impacting the shareholders' equity are captured as a part of comprehensive income. Out of it, income statement captures the retained earnings portion, whereas all the remaining things are captured as a part of this other comprehensive income. Now, what are all those small things that are going as a part of that other comprehensive income which don't go into the income statement, or foreign currency translations? We'll look at each of these words at a later point when we are discussing the other topics. The gains or losses that are coming exclusively because of a change in the foreign currency value on the date of purchase versus on the date of payment. The change, profit or loss that is coming as a change in the foreign exchange rate is what is getting captured as a part of the other comprehensive income. We are not treating it as a part of the main income statement. Any kind of unrealized gains or losses coming from cash flow based hedging derivatives, we'll talk about these later. They are not directly captured in the income statement. Similarly, any kind of unrealized gains or losses that are coming from available for sale kind of securities. When I say available for sale, I'm not holding them for a trading period. I'll not dispose them within a next couple of weeks or months. And at the same time, I'll not hold them for maturity. So those kind, I mean, I may sell them off slightly at a later point in time. Those kind of securities, whatever is the unrealized gain or loss, I have to treat it under the other comprehensive income itself. And nowadays, especially when the IFRS is more and more talking about fair value of assets, not the historic value. Now what happens? The assets get revalued every year. So that could result in an increase in the value of the asset. That increase in the value of the asset we directly don't take as a gain in the income statement. Rather, we'll take it as a gain as a part of the other comprehensive income only. Those kind of gains or losses that are coming up, especially the gains, those kind of gains that are coming up because of the revaluation of the asset as a result of the representing it as a fair value, even those kind of gains that are coming up, unrealized gains that are coming up, even they would be treated as a part of the other comprehensive income only. So there are quite a few elements that are not directly going into the income statement, but they are impacting the statement of but they are impacting the shareholders' equity on the balance sheet. So all those elements which are impacting the shareholders' equity but not passing through the income statement, they are captured through the other comprehensive income. And the income statement plus other comprehensive income put together is what is the statement of comprehensive income. So from an analyst standpoint, the analysis of the other comprehensive income needs to be very much elaborate, because these are the elements that are typically not passing through the income statement but are getting into the balance sheet. So the performance of the company is getting affected even with these numbers. So that's where an additional focus for the analyst should typically come from. All right.